Hey there, Ken Zorvich, NFM Lending. Hope you're having an excellent start to your holiday weekend. And listen, hopefully everyone got a chance to take off some time this week because that's what this time of year is for, right? Despite people taking time off and enjoying time with family and the holidays, there was some interesting economic data that came out this week that I just wanted to point out. And that's called QCEW, which is Quarterly Census of Employment and Wages. So just to take a step back a little bit to help everyone understand why I think this data is interesting. So the BLS, the Bureau of Labor Statistics, is in charge of putting out its jobs report for the economy and traders and the markets to all trade off of. And the Fed also uses this data to come up with interest rate policy. Okay, so the Fed has two mandates. They want to monitor inflation and make sure that can stay in check, and they want to monitor jobs. They want to see job creation and job growth. If they don't see that, they may ease interest rates to then relieve some pressure on companies to be able to create more jobs. Simplest way to understand it. So when we've got job reports coming out, the way that the Fed, I'm sorry, the way the BLS gets their information is usually through surveys. Okay. And those surveys are taken from, say, a household level, they taken from a business owner level in order to kind of come up with what they think the consensus is of the jobs that were created. Now, downstream, eventually the real data comes in, and that real data is then shared with the market. Okay. So that real data is determined by the QCEW. All right. So quarter two, 2024 to quarter two, 2025. The BLS said that the economy created 1.4 million jobs. Now, every month when that data would come out, what would happen? The Fed would take this information, investors would take this information and push investments and interest rate policy in certain directions. So, as we saw over the last few years, as jobs were growing each month, you would see interest rates potentially rising. The Fed was either keeping interest rates elevated or maybe raising them, or in this case, refusing to lower them if they thought that the job market was strong. Now, of course, bond market would react to this, and that would dictate mortgage interest rates. Now, QCEW came out and said it wasn't 1.4 million jobs that were created during that time frame. It was actually 420,000 jobs. Okay, so they were off by about a million jobs. So here's what I find really interesting. We created rate policy according to these jobs. People traded and sold off bonds and did different things that impacted mortgage rates during that time frame because of those job numbers. And now that we find this information and we get this information out, do you see interest rates dropping? No. I mean, the Fed dropped interest rates this month, but they said, hey, we may not drop maybe one more time next year. So what I find interesting is, why is the market not reacting to this the same way they reacted to it when the information came out that was wrong? Okay. So what we have here is over a million jobs overstated. So what that tells me is two things. One, if unemployment, which dropped to about 4.1 about 6 months ago, and since then has risen all the way to 4.6, if this continues to rise, it will potentially cause the Fed to want to take certain actions, and even investors in the marketplace to probably position money in certain ways. And two, I have a feeling that we're not going to really change rate policy moving forward unless it's inflation driven. Okay, I know they say they have a dual mandate, but unless we see a big spike in unemployment, these job numbers, even though they're traded off of, even though the Fed has moved interest rates based off of them, and it all seems like it was false, it doesn't seem like it matters much to the market on the downside of it, only on the upside. And so I think the only way we're going to see interest rates drop any further is if we start to see unemployment spike, okay? And then also if we see inflation continue to cool down. So look for that as we get into the start of 2026. what is going to really make an impact on interest rates for all platforms, not only mortgages, credit cards, car loans, continue to see movement on that type of stuff. It's going to be inflation. So listen, if you want to chat about this any further, please feel free to reach out to me. Make sure you get in some time with some friends and family this weekend. Enjoy the holidays. And as always, I'd love to be in this business in 5 years. If you know someone looking to purchase or refinance, please think of me. Have a great weekend.